On the morning of December 3, 2001, thousands of ENRON employees entered a building that no longer represented success. Only hours earlier, the company had filed for bankruptcy. These were people who had spent years believing they worked for one of the most innovative corporations in America. They had watched their executives appear on magazine covers, address Wall Street conferences, and describe ENRON as the company that was building the future. Many had invested their retirement savings in ENRON shares. Some had persuaded relatives to buy the stock. Others had rejected safer opportunities because they believed they were already standing inside the next great American institution. Now, their identification cards, office titles, and stock statements were reminders of something that had disappeared almost overnight. At its height, ENRON reported billions of dollars in revenue, operated across several continents, and enjoyed the confidence of powerful banks, respected auditors, Wall Street analysts, and sophisticated investors. But ENRON's most profitable business was not energy. It was belief. The company found ways to report anticipated profits before receiving the money. It moved poorly performing assets away from public view. It used complicated partnerships to conceal debt, manufacture earnings, and protect investments that were rapidly losing value. The chief financial officer responsible for protecting ENRON's finances was allowed to manage private partnerships that conducted transactions with ENRON. Those arrangements earned him millions while the company he represented moved closer to destruction. When questions finally became impossible to silence, ENRON did not decline gradually. It collapsed. Shareholders lost tens of billions of dollars. Employees lost jobs and retirement savings. One of the world's most respected accounting firms was destroyed, and federal investigators opened what the FBI would later describe as the most complex white-collar crime investigation in its history. This is not simply the story of dishonest accounting. It is the story of what can happen when intelligence loses its conscience, when success becomes more important than truth, and when everyone responsible for asking difficult questions decides that the profits are too attractive to interrupt. This is Case File 003, The Rise and Collapse of ENRON. Before we continue, tell us in the comments where you are watching from. And subscribe to Crimeverse for premium documentaries about the frauds, scandals, and corporate crimes that changed the world. During the final years of the 20th century, ENRON appeared to represent a new kind of American corporation. It was headquartered in Houston, Texas, but its ambitions extended far beyond pipelines and power plants. ENRON presented itself as a company capable of turning almost anything into a market. Natural gas could be traded. Electricity could be traded. Internet capacity could be traded. Weather risk could be priced, packaged, and sold. If uncertainty existed somewhere in the economy, ENRON wanted to stand between buyers and sellers and collect part of the value. The company employed highly educated traders, accountants, lawyers, and executives. It recruited graduates from leading universities and offered them the chance to participate in what ENRON described as a revolution. Inside its headquarters, employees could feel that they were part of something unusually important. The atmosphere was confident, competitive, and filled with money. Outside the company, the image was even more impressive. ENRON's reported net income rose from $703 million in 1998 to $893 million in 1999 and $979 million in 2000. Its annual reports displayed growing businesses and expanding opportunities. Its executives spoke with the authority of people who believed traditional corporations were too slow to understand the new economy. Investors rewarded the story. ENRON's rising share price made employees wealthier on paper, increased executive compensation, and gave the company a powerful financial weapon. ENRON stock could be used to finance transactions, support partnerships, and persuade the market that the corporation was becoming stronger. But that created a dangerous dependency. ENRON's public image, its financing arrangements, and several of its supposed protections increasingly depended on the same thing, a rising share price. As long as investors continued to believe, the system could appear stable. But if the stock began falling, ENRON would not suffer just one problem. Multiple structures could weaken at the same time. And by the time most investors understood that vulnerability, it was already too late. ENRON's origins were less glamorous than the corporation it later became. The company was formed in 1985 through the merger of two natural gas pipeline businesses. Kenneth Lay, an economist and experienced energy executive, became the central figure in the new organization. Lay understood that the American energy industry was changing. For decades, pipelines and utilities had operated within highly regulated systems. Companies often earned predictable returns by owning physical assets and serving established territories. But deregulation was creating new opportunities. Energy could increasingly be bought and sold through competitive markets rather than controlled entirely through traditional arrangements. Lay believed Enron could become one of the greatest beneficiaries of that change. He was persuasive, politically connected, and highly respected in Houston. He knew how to speak to government officials, investors, directors, and employees. To many people around him, Lay did not appear to be building a reckless organization. He appeared to be modernizing an old industry. The early Enron possessed valuable physical assets, including an extensive pipeline network. Those assets generated genuine revenue and gave the company credibility. But Lay wanted growth. He wanted Enron to become larger, more influential, and more profitable than a conventional pipeline business could easily achieve. That ambition created an opening for a consultant from McKinsey named Jeffrey Skilling. Skilling offered Enron a vision that was more aggressive than simply owning and transporting energy. He believed Enron could become a market maker. Instead of depending mainly on pipelines, Enron could connect producers with customers, enter long-term contracts, manage price risk, and earn money from trading. Lay saw enormous potential in the idea. The relationship between the two men would transform Enron. Lay brought legitimacy, influence, and access. Skilling brought intellectual confidence, financial innovation, and an uncompromising obsession with growth. Together, they would build a company Wall Street struggled to understand but was increasingly afraid to doubt. Jeffrey Skilling did not think like the manager of a traditional energy company. A conventional pipeline business owned infrastructure, transported gas, and earned relatively predictable fees. Skilling imagined Enron as a trading institution that could operate without being limited by the physical assets it owned. The idea was powerful. Energy producers needed customers. Large industrial consumers needed predictable prices. Utilities needed supplies. Each side faced uncertainty about what energy would cost in the future. Enron could position itself between them. It could sign contracts with both sides, manage the risks, and create a marketplace where energy obligations were bought and sold. This approach generated real value. Enron's wholesale trading division became an important and successful part of the company. But the model also introduced complexity. A pipeline could be seen and measured. A long-term energy contract required assumptions. What would prices be 5 years from now? How much energy would a customer use? What was the contract worth today? The answers depended on estimates. That gave Enron's managers something extraordinarily valuable: flexibility. Under mark-to-market accounting, certain contracts and trading instruments were recorded at their estimated fair value. Enron could calculate the anticipated profit from a long-term transaction and recognize a portion of that value before the cash was actually received. Used properly, this was an accepted accounting approach for trading activities. But it created a dangerous temptation. If assumptions became more optimistic, the reported profit could become larger. If a project later performed badly, managers would have to acknowledge that earlier estimates were wrong, or find a way to keep the losses from damaging current results. At Enron, meeting Wall Street's expectations became a central measure of success. The company increasingly behaved as though missing an earnings target was unacceptable. The question was no longer simply whether a transaction would make money. The question was whether it could create the number Enron needed to report. To understand Enron, it is necessary to understand the difference between profit and cash. Imagine a company signs a 20-year contract to provide energy services to a customer. The company estimates how much revenue it will receive over those 20 years. It subtracts the costs it expects to pay and calculates the anticipated profit. Under a mark-to-market approach, part of that estimated value may be recognized immediately, but the customer has not yet made 20 years of payments. The future has simply been converted into a present estimate. That estimate might be reasonable. It might also be dangerously optimistic. If energy prices change, costs increase, the customer uses less energy, or the project performs poorly, the future profit may never arrive. Enron's problem was not that every use of mark-to-market accounting was fraudulent. The problem was that estimates could be manipulated and disappointing projects could create losses that executives did not want investors to see. A deal could produce impressive reported earnings immediately while generating little current cash. That difference was often difficult for outsiders to recognize because Enron's financial statements were extraordinarily complicated. The company reported enormous revenue figures, but much of its business involved trading, where large amounts could move through transactions while Enron retained only a smaller margin. The bigger the reported numbers became, the more impressive the company appeared. But size did not necessarily mean financial strength. Cash remained essential. Enron needed money to operate, meet obligations, support trading activities, and reassure counterparties. When reported profits grew faster than available cash, the company increasingly depended on new financing, asset sales, and elaborate transactions. The system looked sophisticated because it was complicated, but complexity was becoming a shield. The harder Enron was to understand, the easier it became for executives to dismiss skeptics as people who simply did not understand innovation. Enron did not merely encourage ambition. It institutionalized competition. Employees were evaluated aggressively. Those viewed as the strongest performers received promotions, bonuses, and opportunities. Those ranked near the bottom risked losing their positions. Supporters believed the system protected excellence. Critics saw something more damaging, a workplace where admitting failure could destroy a career. In that environment, bad news became dangerous. A manager whose project was losing money had several choices. The manager could reveal the problem and risk being blamed, or search for an accounting treatment, transaction, or revised estimate that delayed recognition of the loss. Enron's internal culture rewarded completed deals, reported earnings, and rising business valuations. It did not always reward patience. Employees learned that confidence was valuable. Doubt could be interpreted as weakness. People who questioned transactions sometimes found themselves confronting colleagues whose compensation depended on those transactions succeeding. The company also paid enormous bonuses. This created a direct relationship between the numbers reported today and the wealth received today. A long-term contract might take years to prove successful, but the estimated profit could help produce immediate compensation. When employees are rewarded before the true outcome of a deal becomes clear, the incentives can become dangerously unbalanced. Enron attracted intelligent people. That intelligence did not protect the company. It gave employees more sophisticated tools for solving the wrong problem. Instead of asking how to create durable value, some employees became skilled at finding ways to preserve earnings, defend valuations, and transfer risk. Executives began treating the stock price as evidence that their decisions were correct. Wall Street's approval reinforced their confidence. Each successful quarter appeared to prove that the system worked. But a rising share price cannot transform a weak asset into a strong one. It can only delay the moment when the difference becomes visible. By the late 1990s, Enron had become more than an energy company. It was a symbol of the future. Its executives spoke the language investors wanted to hear: innovation, disruption, technology, markets, and limitless growth. Traditional measures appeared too narrow for the Enron story. The company argued that outsiders should not judge it like an ordinary utility because Enron was creating an entirely different business model. That claim gave management an unusual advantage. Whenever analysts struggled to understand the company, their confusion could be presented as proof that Enron was ahead of them. Most analysts did not want to be the person who underestimated the next great corporation. Banks also had powerful incentives to maintain strong relationships with Enron. The company borrowed money, completed transactions, issued securities, and generated valuable fees. Auditors earned millions from Enron. Directors received information from management and professional advisors who repeatedly presented the company as financially successful. The result was a chain of trust in which almost everyone depended on someone else. Investors trusted analysts. Analysts trusted management. Directors trusted executives, auditors, and lawyers. Credit rating agencies trusted financial disclosures and corporate assurances. The system was supposed to contain multiple lines of defense. Instead, many of those lines became connected to the same assumptions and incentives. Enron's published results appeared to justify the confidence. In its 2000 annual report, the company stated that net income had reached $979 million. Its reputation continued rising. But a basic question remained surprisingly difficult to answer. How did Enron make all of its money? Some parts of the business were profitable and understandable. Other divisions were losing money, consuming cash, or depending on uncertain valuations. As the gap widened between Enron's image and its underlying condition, the company needed increasingly complicated methods to protect the story. And the man who would design many of those methods already controlled Enron's finances. Andrew Fastow became Enron's chief financial officer in 1998. His responsibility should have been straightforward: protect the financial interests of Enron and its shareholders. Instead, Fastow became the central figure in a network of transactions that blurred the line between Enron's interests and his own. Enron faced several financial pressures. It wanted to remove debt from its visible balance sheet. It wanted to sell underperforming assets without recognizing damaging losses. It wanted to protect volatile investments and create earnings that helped the company meet Wall Street's expectations. Special purpose entities offered possible solutions. A special purpose entity is a separate legal organization created for a limited transaction or objective. These structures are widely used in legitimate finance. But for an entity to be treated as truly separate, it must satisfy accounting requirements, including requirements involving independent investment and genuine economic risk. If Enron controlled the entity or secretly protected outside investors from loss, the structure might not deserve separate treatment. Fastow created and managed partnerships known as LJM1 and LJM2. The conflict was extraordinary. Enron's chief financial officer was allowed to manage private partnerships that entered transactions with Enron. He could stand on both sides of a negotiation. As Enron's CFO, he was supposed to obtain the best possible terms for Enron. As the manager of LJM, he had incentives to produce profits for himself and his investors. Enron's board approved waivers of the company's conflict of interest rules to permit Fastow's involvement. Controls were supposedly established. But the Senate investigation that followed Enron's collapse concluded that the board failed to provide adequate oversight of the transactions and compensation arrangements. The structures that were presented as financial solutions would eventually become evidence of how far Enron had traveled from ordinary business judgment. LJM was presented as an independent source of capital that could complete transactions quickly when other buyers were unavailable. In theory, this could benefit Enron. In practice, the partnerships became tools through which poorly performing assets could be moved, earnings could be manufactured, and Fastow's associates could profit. The transactions were often extremely complicated, but the central problem was simple. Enron needed LJM to appear independent, while the economic relationship frequently depended on protections, understandings, or support connected to Enron. In some transactions, Enron appeared to sell an asset and record earnings or cash flow. But if Enron remained responsible for the risk, the transaction was closer to financing than a genuine sale. The SEC later accused Fastow of using undisclosed side deals, sham transactions, inflated valuations, and backdated documents. One of the advantages of complexity is that responsibility becomes difficult to trace. Lawyers can focus on documentation. Accountants can focus on technical rules. Directors can focus on presentations. Executives can claim they relied on advisors. But paperwork does not change economic reality. If a supposed buyer is protected from meaningful loss, the risk has not truly been transferred. If an asset is moved away from the balance sheet only temporarily, the underlying weakness has not disappeared. And if the company's chief financial officer earns private profits from the transaction, the conflict cannot be solved merely by placing another approval signature on a document. Fastow and others earned millions from the LJM arrangements. Meanwhile, Enron used the partnerships to preserve an image of predictable growth. The company was not repairing its weaker businesses. It was creating distance between those businesses and the numbers investors could see. Some of Enron's most important hidden risks were connected to investments whose market value could change dramatically. If those investments fell, Enron would normally have to recognize losses. The company wanted protection. The solution was a series of entities known as the Raptors. These structures supposedly hedged Enron's investments. A hedge is meant to reduce risk. When one asset declines, the hedge should gain value and offset part of the loss. But the Raptors had a fatal weakness. They were supported largely by Enron's own shares and related instruments. That meant Enron was effectively attempting to protect itself with its own value. Imagine using one part of a building to ensure another part of the same building against collapse. As long as the entire structure remains strong, the protection appears valuable. But when the foundation weakens, both the asset and its supposed protection can fail together. That was the danger inside the Raptors. As Enron's share price declined, the structures became less capable of covering losses. The SEC later alleged that Skilling, Fasto, Chief Accounting Officer Richard Causey, and others used the Raptors to manipulate Enron's financial results. In one transaction involving Enron's investment in Avicii Systems, documents were backdated to make it appear that the value had been protected when the investment was trading near an earlier high, even though its price had already declined. The Raptors did not eliminate Enron's economic losses. They delayed public recognition of those losses. This distinction was crucial. Enron's financial statements could appear protected while the company itself remained exposed. As long as Enron's stock stayed high, the machinery could continue operating. But once the stock began to fall, the hidden connection between Enron's investments, its partnerships, and its own shares became a threat to the entire company. Enron's most successful operation was its wholesale energy trading business. But the company wanted investors to believe that the same brilliance could be repeated everywhere. Enron Energy Services promised to manage energy costs for businesses and large institutions. Customers could outsource their energy needs to Enron, which claimed it could modernize facilities, improve efficiency, and produce long-term savings. The concept sounded promising. The financial performance was far less impressive. The SEC later alleged that Enron executives concealed hundreds of millions of dollars in losses connected to the retail energy business by moving portions of those losses into the profitable wholesale division. This made the weaker business appear healthier while reducing transparency about the stronger division's true results. Enron Broadband Services produced another powerful story. During the technology boom, internet traffic was growing rapidly. Enron promoted the possibility of trading bandwidth in the same way it traded energy. Executives made ambitious statements about the technology, the network, and the potential value of the business. But the broadband division struggled to produce the performance investors had been encouraged to expect. International projects created additional pressure. Large energy developments required enormous capital and operated within complicated political and economic environments. Some projects became valuable assets. Others produced disappointing returns or losses. Enron had built a public identity around continuous growth. That identity left little room for honest failure. When a business underperformed, executives could close it, accept the loss, and explain the mistake. Or they could move losses, adjust assumptions, restructure transactions, and insist that success remained just beyond the next quarter. Enron repeatedly chose the second path. Each decision protected the image temporarily. Together, those decisions made the final collapse more severe. A fraud as large as Enron's could not remain hidden because of executive deception alone. It also required failure among the institutions responsible for asking questions. Enron's board of directors had access to information about the company's unusual transactions. The board approved Fasto's conflict of interest arrangements and was repeatedly informed about related party dealings. After the collapse, a Senate investigation concluded that the board had witnessed warning signs and failed to protect shareholders adequately. Arthur Andersen served as Enron's external auditor. An auditor is supposed to provide independent assurance that a company's financial statements fairly represent its condition. But Andersen's relationship with Enron extended beyond auditing. In 2000, the firm received approximately $25 million in audit fees and about $27 million for consulting and other services. That did not automatically prove misconduct, but Arthur Andersen was already connected to many of the accounting decisions in question. Fasto remained chief financial officer. The company continued telling employees and investors that it was strong. This period is important because Enron's collapse was no longer an unforeseeable accident. Senior leadership had received a direct warning that the company's accounting structures might threaten its survival. There was still time to tell the market the truth. There was still time to remove conflicted executives, preserve documents, and expose the transactions. But honesty would have required Enron to admit that years of reported success could not be trusted. The company chose reassurance. The market would soon receive the truth in a far more destructive form. On October 16, 2001, Enron announced its third-quarter results. The company reported a loss of approximately $618 million. It also disclosed a reduction of about $1.2 billion in shareholder equity connected partly to transactions involving partnerships associated with Fasto. For investors accustomed to Enron's carefully managed growth, the announcement was alarming. The numbers were not merely disappointing. They raised questions about transactions many shareholders had never properly understood. Days later, Fasto was removed from his position. The Securities and Exchange Commission began examining Enron's related party transactions. Confidence started collapsing. Banks, trading partners, and investors wanted clearer answers. But Enron's complexity now worked against it. The company could not explain the partnerships without revealing additional weaknesses. Each disclosure led to another question. On November 8th, Enron announced that it would restate financial results covering several previous years. The restatement reduced previously reported earnings by hundreds of millions of dollars. It also confirmed that entities that had been treated as separate should have been consolidated into Enron's financial statements. This was a devastating moment. Enron had spent years telling the market that its profits were reliable. Now it was acknowledging that important parts of its financial history were wrong. Creditors began protecting themselves. Trading counterparties became reluctant to conduct business without additional security. Rating agencies reconsidered Enron's debt. For a trading company, confidence was not an abstract public relations advantage. It was operational oxygen. Enron needed other companies to believe it could honor contracts. Once that belief weakened, the company required more cash precisely when access to cash was disappearing. The collapse had entered its final stage. In November 2001, Enron appeared to find a possible rescuer. Dynegy, another Houston-based energy company, agreed to acquire Enron in a transaction supported by Chevron Texada. For employees and investors, the proposed merger offered hope. Enron's independent future might have disappeared, but a larger collapse could possibly be prevented. The deal required Dynegy to understand what it was purchasing. That was the problem. As Dynegy examined Enron's finances, additional weaknesses emerged. Enron's trading business was losing counterparties. Its cash position was deteriorating, and the company's credit rating was moving toward collapse. The proposed rescue depended heavily on continued confidence. But every new disclosure made Enron less valuable and more dangerous to acquire. On November 28th, major rating agencies downgraded Enron's debt to junk status. The downgrade triggered additional obligations and made the company even less capable of surviving. Dynegy abandoned the merger. Without the rescue, Enron had almost no remaining path forward. The speed of the destruction was extraordinary. A corporation that had reported more than $100 billion in revenue for the previous year was now unable to persuade markets that it could survive. This revealed the difference between reported size and financial resilience. Enron had created enormous transaction volume, complicated assets, and impressive accounting earnings. But when creditors demanded cash and counterparties demanded security, the company could not produce enough genuine strength. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. At the time, it was the largest corporate bankruptcy in American history. The company that claimed it could create markets for almost anything had finally discovered something it could no longer trade: its own credibility. The collapse was described through stock charts, balance sheets, and bankruptcy filings. But the human cost could not be contained inside financial documents. Thousands of employees lost their jobs. Many had invested heavily in Enron stock through retirement plans. They believed the company's success would finance their futures. Some employees had watched their retirement accounts rise dramatically during Enron's strongest years. The numbers created a sense of security. Then the stock collapsed. The Department of Labor reported that many Enron employees lost between 70% and 90% of their retirement assets after the company announced that it would restate profits. The losses were especially painful because employees had received repeated messages expressing confidence in Enron. While ordinary workers watched their savings disappear, senior executives had sold substantial amounts of stock during earlier periods. Not every executive stock sale was illegal. Corporate leaders frequently sell shares for legitimate reasons. But the contrast was devastating. Employees had been encouraged to believe, while some people near the top had converted shares into cash. Retirement savings represent more than money. They represent years of work, delayed spending, and confidence that today's sacrifices will create security tomorrow. For Enron's workers, that promise disappeared because the company's reported success had been built partly on information they could not trust. The scandal exposed a painful danger of concentrating retirement savings in an employer's shares. If the company fails, workers can lose both their income and their investments at the same time. Enron's executives had spent years praising risk, innovation, and competition. But when the company collapsed, the people least responsible for designing its financial structures absorbed some of the greatest personal damage. As Enron moved toward collapse, its auditor faced a crisis of its own. Arthur Andersen had been one of the most respected accounting firms in the world. Its name represented professional credibility. But Andersen had approved Enron's financial statements while earning millions of dollars from the company. When investigations began, attention turned to Enron-related documents held by the auditing firm. Employees destroyed large quantities of records under document retention procedures. The timing created the appearance that evidence was being eliminated as regulatory scrutiny approached. The Justice Department charged Arthur Andersen with obstruction of justice. In 2002, the firm was convicted. The consequences were immediate. Clients left. Employees departed. Andersen's auditing business disintegrated. But the legal story did not end there. In 2005, the United States Supreme Court unanimously reversed the conviction. The court concluded that the jury instructions had failed to require the necessary finding of criminal consciousness of wrongdoing. The ruling was a major legal victory. Commercially, it arrived too late. Arthur Andersen had already been destroyed as a major auditing firm. The collapse demonstrated how trust functions in professional services. An auditor does not sell factories, energy, or technology. It sells confidence in its judgment and independence. Once clients believed the Andersen name could no longer protect their own credibility, the organization had little left to preserve. Enron had not only destroyed itself, it helped destroy the institution responsible for assuring investors that Enron's numbers could be trusted. Enron's bankruptcy created an investigative challenge of enormous scale. The transactions involved partnerships, banks, offshore entities, derivatives, complex accounting treatments, and years of internal communications. Investigators needed to determine not only what had happened, but who understood it and when. The FBI, Department of Justice, Securities and Exchange Commission, Internal Revenue Service, and other agencies combined their resources. In January 2002, agents searched Enron's 50-story headquarters in Houston. The operation lasted 9 days. Investigators removed more than 400 boxes of evidence and conducted over 100 interviews during the early stages. Electronic communications became especially valuable. Emails could reveal what executives understood privately while they presented a different message publicly. The government created the Enron Task Force to coordinate criminal investigations and prosecutions. The work continued for years. Investigators followed financial transactions, reconstructed accounting entries, and negotiated cooperation agreements with former executives. The complexity that had protected Enron now became a burden for the people who had designed it. Every partnership required documents. Every transaction required approvals. Every payment left a trail. The government brought charges against senior and mid-level executives, bankers, and others connected to Enron transactions. Some defendants pleaded guilty. Others went to trial. The investigation eventually reached the 3 men most closely associated with the scandal: Andrew Fastow, Jeffrey Skilling, and Kenneth Lay. To prove the case against Enron's leaders, prosecutors needed insiders who could explain how the company's public claims differed from what executives knew privately. Andrew Fastow would become their most important witness. In January 2004, Andrew Fastow pleaded guilty to 2 counts of conspiracy involving securities and wire fraud. He agreed to cooperate with federal prosecutors. For the government, Fastow offered something no outside expert could provide. He had designed and managed central parts of the partnership system. He understood the side agreements, the conflicts, and the reasons Enron used particular transactions. Fasto admitted participating in schemes that manipulated Enron's financial results and enriched him at the expense of the company and its shareholders. His cooperation placed enormous pressure on Lay and Skilling. But Fasto was not a simple witness. He had personally profited from Enron's corruption. Defense lawyers could argue that he was blaming others to reduce his punishment. That tension made his testimony both powerful and vulnerable. Fasto described understandings that were not always contained completely in formal contracts. He explained how transactions could satisfy appearances while failing to transfer genuine economic risk. His account helped prosecutors translate Enron's complexity into a story jurors could understand. The company did not collapse merely because one chief financial officer secretly created partnerships. The government argued that senior leaders understood that Enron's public image depended on concealed weaknesses and misleading statements. Fasto was eventually sentenced to 6 years in prison. His transformation from celebrated financial executive to government witness captured the moral emptiness at the center of Enron. The people who had called themselves the smartest in the room were now competing to explain why someone else deserved greater responsibility. The trial of Kenneth Lay and Jeffrey Skilling began in Houston in January 2006. The government argued that both men had participated in a broad conspiracy to mislead investors about Enron's true condition. Prosecutors presented former executives, internal records, financial evidence, and public statements. The defense offered a different explanation. Enron, they argued, was a real company destroyed by a sudden crisis of confidence, aggressive short sellers, negative publicity, and misconduct committed by subordinates. Skilling maintained that he believed Enron was strong when he resigned. Lay argued that he had relied on the people responsible for detailed financial operations and had attempted to save the company when he returned as chief executive. The trial lasted several months. At its center was a question that appears in many corporate fraud cases. Did the leaders knowingly lie? Or were they optimistic executives who failed to recognize how serious the problems had become? On May 25, 2006, the jury delivered its decision. Skilling was convicted on 19 counts, including conspiracy, securities fraud, insider trading, and making false statements to auditors. He was acquitted on 9 additional insider trading counts. Lay was convicted on all counts submitted to the jury. In a separate proceeding, the judge also found him guilty of bank-related charges. But Lay died in July 2006 before sentencing. Because he died before completing the appeals process, the court later vacated his convictions and dismissed the indictment under the legal doctrine then applied to his case. Skilling initially received a sentence exceeding 24 years. After years of appeals and legal proceedings, he was resentenced in 2013 to 14 years and ordered to forfeit approximately $42 million for victim restitution. Enron did not collapse alone. Its failure damaged public confidence in corporate financial reporting, executive leadership, auditing, and Wall Street oversight. The scandal was followed by other major corporate failures, including WorldCom. Americans began asking whether the existing system gave executives too much freedom to manipulate numbers while imposing too little accountability on auditors and directors. In 2002, Congress passed the Sarbanes-Oxley Act. The law introduced major changes to corporate governance and financial reporting. Senior executives became personally responsible for certifying important financial statements. Companies faced stronger internal control requirements. Restrictions were placed on certain relationships between auditors and their clients. The law also created the Public Company Accounting Oversight Board to supervise auditors of public companies. These reforms could not eliminate corporate fraud. No law can force every executive to become honest. But Enron demonstrated that markets depend on more than entrepreneurship. They depend on reliable information. Investors cannot make rational decisions when financial statements are constructed to hide economic reality. Directors cannot protect shareholders when they treat management's confidence as a substitute for independent judgment. Auditors cannot serve the public when preserving a client relationship becomes more important than challenging the client. Enron's legacy is therefore larger than one company. It changed how executives, boards, and auditors were expected to demonstrate accountability. But laws written after a disaster cannot restore the years employees lost, rebuild retirement accounts completely, or reverse decisions investors made using false information. Regulation can reduce the possibility of repetition. It cannot erase the consequences. Enron sold natural gas, electricity, financial contracts, and energy services. But the product that sustained the corporation was belief. Employees believed the executives. Investors believed the earnings. Directors believed the presentations. Analysts believed the growth forecasts. Banks believed the company would remain valuable. Auditors allowed the market to believe that Enron's financial statements could be trusted. That belief created real power. It raised the share price, attracted employees, opened access to financing, and allowed Enron to complete transactions that would have been impossible for a company viewed with suspicion. But belief is not permanent capital. It cannot replace cash. It cannot make a failing investment profitable. It cannot transform a conflicted partnership into an independent buyer. And it cannot prevent a debt from becoming payable. Enron's leaders were surrounded by intelligence. They employed talented accountants, lawyers, traders, and financial experts. The company did not fail because no one understood the rules. It failed because too many people became skilled at using the rules to protect an appearance that no longer matched reality. Every hidden loss created the need for another transaction. Every aggressive estimate created pressure to produce a larger estimate later. Every misleading statement reduced the possibility of telling the truth without causing immediate damage. Eventually, Enron was no longer managing an energy company. It was managing the distance between what the company was and what the public believed it to be. When that distance became impossible to maintain, the collapse happened with extraordinary speed. A share that once represented confidence became nearly worthless. A headquarters that represented ambition became evidence. Executives who described themselves as innovators became defendants. And thousands of employees learned that the institution holding their careers and retirement savings had never been as secure as they were told. The lesson of Enron is not that ambition is dangerous. Ambition builds companies, creates markets, and transforms industries. The danger begins when success stops being the result and becomes the story that must be protected at any cost. Because once a company becomes more committed to appearing successful than being honest, every achievement becomes temporary, and every lie becomes a debt. Sooner or later, that debt must be paid. This was Case File 003, Enron. Subscribe to Crimeverse for more premium documentaries examining the frauds, collapses, and corporate crimes that changed the world. The next case file is Wirecard, the European financial technology giant that claimed to hold billions of euros which auditors later discovered could not be found.